Who do you recommend should do their financials?
Maybe a CFO instead of CEO?
Oh, I'm sorry, if they don't have a CFO, that was my question. If they don't have a CFO, they can't afford one just yet, who do you recommend would do them? Did she freeze? Okay, I think she's frozen.
She may be frozen. I know she has there we go.
Hang on, everyone. It's the joys of Zoom. We'll figure it out in just a minute.
Looks like she's moving now. We got
there she goes. Okay, go ahead, Jeannie. I'm sorry you got cut off. She's moving, but can't hear her.
Another computer if we need to. You can't hear me?
We can hear you now. Go ahead.
I was afraid this might happen. You can hear me now? Okay, good. All right. So, so if you suggest that you get somebody on your board that has a little financial background, and that person coach the CEO on how to put stuff together. Maybe the paying the checks can be done by that person. If you need to be a little bit bigger than that, there are quite a few firms in town that will do your bookkeeping for you for a very reasonable monthly cost, and they will do whatever you want. They'll do your payroll, they'll pay your bills, they'll generate your financial statements, whatever you want, you tell them and they'll give you a price for that service. So that's what I would recommend if you're small, is to look for one of the really small accounting firms in town, that bookkeeping firms in town that can do that for you.
So along those same lines,
it is important to have somebody on your board who, it's really important to have somebody on your board who understands financials and can coach you on that and help make sure you get a good person.
So along those same lines, if someone were going to choose a CPA accountant or one of these firms that you just mentioned to us, do they need to look for a firm or a person with specific nonprofit experience? What do you recommend?
I would recommend that you do, just because there are a few things, specifically grants, donations that may be restricted, that are tricky to account for if you do not have any not-for-profit experience. And I did send you a couple slides. We can talk about those issues and you can see why they're tricky. And so I've actually referred clients to small accounting firms and then discovered that that accounting firm needed some coaching on how to record those entries. So I would recommend you get somebody with not-for-profit experience.
Do you want to pull up your slides and go through?
Do you? Yeah, I do. You'll have to allow me to do that though. You have not allowed screen sharing. Maybe you'll have to make me a temporary host. I don't know.
Becky's saying, okay, that you're ready to go.
Okay, here we go. Let me get on this to slideshow just a sec. There you go. So that's just me. And I'm not kidding when I say, if you have any questions, please feel free to send me a text or send me an email, and I'm happy to help you figure stuff out. Let's go to that part of accounting for pledges, since that's the, let's go back one. Let's see, how do I go back? I'm not very good at this. I would do slideshow again. Beginning. All right. All right, so here's the tricky part. When a donor gives you money, they can give you money 3 different ways. It can be permanently restricted, which means you can't ever spend that money. You can only spend the earnings. and most likely it's going to be restricted for one purpose. Example would be when somebody gives University of Texas, San Antonio, $1 million for the endowed chair in not-for-profit research. They can't ever spend that $1 million. They invest it and maybe it makes 5%. And so they get to spend $50,000 a year from those earnings on the chair. Temporarily restricted also has strings attached. It has to be used for whatever that donor said. So maybe you need to buy a van. Maybe you need to build a new building. Maybe you need to hire a specific person, and a donor gives you money for that. You can't use it for anything else, but you can spend all the money. So that's pretty good money. Unrestricted is the CFO's favorite kind. It's when they just give you money and say, you just use it wherever your need is greatest. And so you can use it to pay the rent, you can use it to pay salaries, you can use it whatever you want. You account for each of those things differently. And at some point, if you want, Becky, did you send out those 2 Utah Habitat for Humanities statements?
I am going to post the file in the chat, so I can do that right now.
Oh, all right. So then I want to just mention the last kind of thing down there called board designated funds. So say you had a really good year. I heard that the Symphony did so well on the federal government's paycheck protection plan that they're going to post a positive bottom line for the first time in forever. So say you're the board and you say, oh, well, let's set some of that money aside and use it in coming years when we're going to need that money. You can set aside the cash, but you cannot defer the recognition of that revenue. It's just like if you won a bunch of money in Las Vegas and you said, oh, I'm not going to put that on my tax return this year because next year I'm going to buy a boat and I want to use it for that. Or next year I'm going to buy a rental house. I'm going to use it for that. The IRS doesn't care what you're going to use it for. If you got it this year, you have to pay taxes this year. That's the way all revenue is. If you earned it this year, you have to recognize it this year. You can set aside the cash for future years, but you can't say I'm going to count that revenue in a subsequent year. So there's no such thing as a rainy day fund. That's what boards always want to do. Let's set up a rainy day fund. You can set aside the cash. Go ahead.
Along those lines, we had a question. Who decides on the restriction, the funder or the fundee?
It's only the donor.
Okay.
The donor decides what it's restricted for. If you, the recipient, got to decide what you were going to use it for, then it would be unrestricted because you could use it however you wanted. But and just to also point out, temporarily restricted is not only restricted to buying or using it for a specific thing. Sometimes it's a time restriction. You might have a donor that says, I'm going to give you $1 million, but you can only use 1/3 of it every year for the next 3 years. Here's the tricky part, which is what we're going to talk about next, is that when that donor gave you a written pledge for that $1 million, the whole $1 million gets recognized as revenue in the year that they made that pledge. So what you would do is you would, when you recognize that $1 million as a pledge receivable, and you recognize the revenue. When the payments are received, you obviously book it to cash, and you then decrease the pledges receivable. You do not recognize revenue again. And I've seen organizations get in really bad financial situations. One of my clients had a grant where they were getting $600,000 over 3 years, and they recorded, just like they should, they recorded that $600,000 as revenue the first year. But then in year 2 and year 3, when the payments came in, the clerk who was booking it said, oh, it's payment, it must be revenue. And they booked the revenue again. So they ended up overstating the revenue by $400,000, and that was a big problem. So make sure if you do get pledges that are paid out over multiple years, that somebody is checking when those payments come in to make sure they're recorded correctly, because it's a big potential liability. And these two things, this recognizing donor gifts in the right category and accounting for the pledges is really tricky. And if your accounting firm is not familiar with them, they can screw it up. So it's this issue in particular, why you want an accounting firm that understands not-for-profit accounting.
So is there a difference, Jeannie, on fee for service if it's still part of a grant and you have to complete, let's say, an event? You have 4 events throughout the year, and after the events happen, then you submit the paperwork to the funder, and then you receive payment on that full grant that they offered. How does one book that?
If they promised you, I don't know, maybe they promised you, if you had to do 4 events, maybe they promised $400,000. When they promise the $400,000, it's recorded when that pledge is received. And then when you actually get the payment at the end, you don't recognize the revenue again, but you do just recognize the cash and relieve that restricted credit. If Becky, I'm going to get out of this full screen, and I want to let's see, how am I going to
Press escape.
there you go. All right. So if you go to the chat where Becky's posted that, I want to just look at the financials there for a minute.
Do you want me to share it on the screen?
Yeah, that would be great if you would do that. It would be great if you would do that.
Which one, the audit or the 990? I'm sorry. I have the Utah
I
audit.
want you to do the audited financials. The audited financials, yeah.
Everybody see that? Give me thumbs up.
I can't see it, no.
Jeannie, hit stop share on yours.
Stop share. Let's see. Let me.
It's a little red thing on the top.
I need to get back to the. Let's see. Stop share. Pause share. Okay, there we go. Stop share. All right. So Becky, if you would go forward on that to the page that says a statement of activities. Next page. Yeah, there you go. All right. So let's see. So if you see down there, it's the line that says, so in the top section of revenue. So on no, yeah. So revenue is divided into 2 parts for not-for-profits: support, which is all your donations, and then revenues, which is things that you did that you charged people for. So at the bottom, the right before the total support line, where it says net assets released from restriction. So go up with your cursor. It's net. It's that line right there. So just if you look at the columns here, the columns say you actually keep separate financials for your unrestricted money, your temporarily restricted, and your permanently restricted money. And so what donors over the course of this year gave them $157,000 in contributions and $207,000 in grants, and they earned $11,000 from their special events. So when you actually do what the donor told you to do with that money, then you release it from restriction because you've done what the donor said. So you see the lines that Becky has circled, you'll see a negative $313,000 in the temporarily restricted and a positive over in the unrestricted column. So that's where you move the revenue over and show it in your unrestricted. And the reason that's important is because the expenses that it took to do whatever the donor asked you to do are posted in the unrestricted column. So that way you've got unrestricted revenue matching the unrestricted expenses. So that's the other tricky thing about not-for-profit accounting that somebody who's not familiar with it wouldn't know, is that you do have to keep a separate set of books for each of the restricted funds, and that when you actually use it, you record that and move it all to unrestricted on this particular line. So that's one of the tricky parts. Any other questions about these financials? If you want, I know Arlene, you said you had a question about what are the financials really called? So on the page before this, you'll see that we have what's called the statement of financial position. Everybody used to call that the balance sheet. And the reason they call it the balance sheet was that the total assets of the $4.8 million have to match the $4.8 million that's at the bottom of that screen if you scroll forward just a little tiny bit. See, there, your total liabilities and your net assets are also, go back down. There you go. So at the very bottom of the page, you see your total liabilities and net assets are 4.8 million, and your total assets are 4.8 million. Those two numbers have to match. That's what you say is everything that you own is on the top. The liabilities are what you owe, and the sum of all your profits and losses from all other years is what goes in that net assets. So, so what you owe minus what you own minus what you earned in prior years, or plus what you earned in prior years, that has to all balance. So that's why it's called the balance sheet, but the auditors decided they wanted it to have a different name, so they named it statement of financial position. And the next page,
how is that different for statement of activities?
All right, so if you roll forward, this one is called the statement of activities, and it's got lots of old names. It was called the income statement, the profit and loss statement, so all of those are potential names for this. They're all the same. And the thing that also on the same page that has lots of different names, if you scroll down just a little bit more, Becky, on this page, the line that says change in net assets, the change in net assets is the difference between revenue and expenses. So I think change in net assets is a confusing name because it's really your profit, or it's really your gain or loss, or it's really your excess of revenue over expense. Those are all names that this used to be called back before the generally accepted accounting principles decided to name it this. So
we also have the statement of cash flows. So tell us what
the statement of cash flows, and the statement of cash flows has pretty much had the same name. That name hasn't changed. I will say the statements are listed here in the order of what the auditors think is important. And I think part of that is that the statement of financial position, that shows if you've got a lot of debt. It shows, and if you go back up here, you can see to that sheet and look at what the statement of finance, go back one more schedule, Becky, there you go. If you look at this and scroll down just a little bit so you can look at liabilities, you can see that Utah Habitat for Humanity has a long-term loan. They borrowed $1.2 million. And so if that number was substantially bigger, if it were bigger than the net assets, that would be a big red flag because you don't want to have borrowed more than what you're worth. So, so this really shows the health of the organization, the statement of financial position. And then the next page, the statement of activities, really just shows what happened this year. But the statement of financial position is the sum total of what's happened forever. So, so yeah, that's that.
Okay, so, and we are looking at the audit. So what does the audit tell us or tell a funder compared to the 990? What's the difference between those two and what should we know about them?
Well, so if you go back up to the well, not the title page, but the first page in here, Becky, yeah, that page right there. If you scroll down to the bottom a little bit, this is just sort of says what the auditors did And the main thing that auditors are doing, just so you understand, auditors are just looking at your accounting records and making sure that you're not missing anything, that you're fairly representing stuff. They don't look for fraud. That's not what an audit does. They may find some, but that's not what it's designed to do. So just so you know, you can still have people stealing money from you even though you have an audit. But the thing you're paying for is that last paragraph where Becky's cursor is, the one that says opinion. And what you want, no, at the very bottom where your cursor was a minute ago. Yeah, right there. Opinion. And this is what you're paying for. You want what's called a clean opinion, where they're saying, yep, we think the financials fairly represent what happened. The bad things you don't want them to say something like that there was a material weakness. That would mean there was that your computer system was missing a whole bunch of data, or you had such bad policies in place that your staff could have been stealing from you, or you were doing so many cash transactions and not recording it that they really couldn't verify what was going on. So this is really what the funder is going to look for, is that you've got a clean opinion, and then they're going to look at that page we just looked at, the statement of financial position, just to make sure that your debt is not really big compared to what your assets are. And then they're going to look at your income statement just to see how you did this year. Did you make a profit this year or not? So that's what we look at.
We have a question from Celine. She says, so change in net assets is the same as net operating income, right?
Yeah, pretty much.
Okay. And then another question just in regard to the opinion. If it is not positive, completely positive, can you do anything to correct that for this? Or do you have to wait until the next audit?
You pretty much have to wait for the next audit. I mean, you can negotiate with your auditors, but they're auditing a specific set of books for a specific year, and they're doing it after the fact. So you can't go back and change what you did that year. Now, that said, in the course of the audit, if they find something, the auditors will recommend audit adjustments. And so if you opt to include those audit adjustments, your financials may look different than what you've been thinking they looked like for the whole year. So if you incorporate the audit adjustments, then they are more likely to give you a clean opinion because you've incorporated that. So if you're a board and you get an opinion that's not a clean opinion, what you might want to do is ask for what's called a management letter, and it's a separate document. And it's where the auditors tell you all the stuff they think you should be doing. They might say something like, we really feel it would be important for you to upgrade to a new accounting program, or we really feel it would be important for you to establish some written financial procedures, or we really feel it would be important for you to implement some conflict of interest statements for your board, because we've got potential for conflicts of interest between your board and your organization. Whatever it is they're concerned about, they'll write it in that management letter. The management letter does not generally go to funders. The funder has to know to ask for it. So auditors, I'm sorry if there's any auditors in the audience. The management letter is sometimes, this used to be a lot worse, is sometimes a thinly veiled consulting proposal. We think that you need to write the procedures, and we would be happy to do that for you for a price. That was one of the things that changed about 20 years ago, is that clients really complained that the management letters were sort of if you wanted a clean management letter, then you had to hire them to do the stuff to fix it, and that wasn't right. So that got fixed. But you'll know that the other thing they included in the management letter is just warning you of what's coming. There have been some really big changes in accounting practices, some that affect not-for-profits. A big one was, they changed the way membership revenue is categorized. The membership revenue is now separated from donations. So your staff will have to figure out when somebody gives you $1,000, what are they really getting of value for that? If that's free admission to the museum and they come once a month and it costs $20 to get in, well, that's $240. So they figure that out, and that's not considered part of their contribution. So so they also put all that kind of stuff in your management letter, just warning you what's coming.
In regard to the audit, when does an organization need to conduct an audit?
I think your funders will tell you that. So if you're just rocking along and you just got little donations and your board is comfortable with the books, you're probably okay. If you get a big grant, if you get a big Gronkowski grant or something else, they may say to you, we need you to get an audit, because they want to know that their funds are being used appropriately. So I would say that to me is, it's either going to be the federal government telling you you need an audit, or if you get money from the city or the county, it's going to be them telling you that you need an audit. If you go and Google it, there'll be places that say, oh, if your revenue is $1 million or $2 million, you need an audit. And your board needs to decide when you have enough revenue, enough bottom line to justify the cost of an audit, because audits aren't cheap. So, so it's a trade-off. But
and along the lines, for someone who's just maybe going to do an audit for the first time, what is an average range, do you think, in terms of paying?
Well, there's a small group of audit firms in San Antonio that target small not-for-profits, and I would think that you could probably get something for $5,000.
Okay.
But you know, inflation happens, so I could be out of date on what that could be.
How does the audit differ from the 990? What is the difference in the information, or what is it telling the funder? What do we need to know?
Right. So for starters, most small organizations, even if they have an audit, they do their own 990. So 990 is definitely something you can do yourself. It's a booger. I will tell you, it is a hard form, and they have some of the most obscure schedules. I don't know who could possibly have dreamed up the stuff that's on them, but it's really weird. But you can do them yourself. So let me just tell you a little bit about the origin of this Form 990. Back 20 years ago, there was a lot of negative press about the CEOs of the larger not-for-profits stealing money, or taking the whole board to the Bahamas for their board retreat, or just inappropriately using the funds of the not-for-profit. And the IRS got really concerned about that, and they wanted to change behavior, but they didn't. They did it in a very sneaky way. They did not do it through regulation or through legislation. What they did was they changed the Form 990. So the Form 990 used to be a much simpler document, and it went from about, 5 or 8 pages to 20 pages. And if you thumb through the Form 990, you'll find 4 pages of questions. 2 in particular really have to do with the governance of the organization. And they ask things like, did you make any loans to board members? Did board members make any loans to you? Are you in a joint venture with a for-profit entity? Do you have a conflict of interest policy? Do you keep board minutes? They wanted to know that people were using good business practices. It was not too long after Sarbanes-Oxley, and so a lot of what they incorporated were things that were good business practices for Sarbanes-Oxley, which do not apply to not-for-profits, but represent good ways to do business. So, for example, a whistleblower policy. They ask if you have a whistleblower policy. And a lot of not-for-profits have come to believe that that's so anyway, so they came up with this huge new Form 990, sent it out, told all the not-for-profits to fill it out. And they sincerely believed that most not-for-profits wouldn't do it because there's no enforcement side of the Form 990. People don't get audited on their Form 990s. I don't really know if anyone looks at them to see what they say. And they just didn't think anybody would fill it out. And they were stunned that not-for-profits filled out all the sections. And over the course of the next 5 to 10 years, not-for-profits all have come to believe that what's ever asked about on the Form 990 is legally required. It isn't. It's just a question on the Form 990. So the IRS was so smart because they got everybody to change their behaviors and they didn't have to pass any regulations or legislation. So it was very smart of them, very smart.
Very manipulative.
Yes. Very manipulative.
How is can you tell us the difference between the standard 990 and the postcard, and what are the requirements? Or
yeah, so if your revenues are less than $50,000, you can just do a 990N. If they're a little bit higher, and I have a slide about this in another presentation, but if I think your revenues are less than $200,000, you can file a 990EZ. And then if you're over that, then you need to file the regular full 990.
And with all of your experience, Jeannie, what would you recommend to us in terms of getting prepared for the 990 for an audit? There's a lot of anxiety and dread around it for a lot of individuals, and I think a lot of it probably could be preparation.
Oh, absolutely.
So what do you suggest on how we make it the most efficient, providing the information needed, and decrease that anxiety that everybody has around it?
Right. So let's see. So so if you're going to get ready for your auditor is going to send you a list of all the documents they're going to look at. So make sure you get all those together. And a lot of it's just going to be, sometimes they're not going to want to see all of the bills you pay. They're just going to want a sampling. And they'll say, I want to see everything you paid to CPS and whoever this consulting firm is. They'll want to see some payroll records. So they'll say, I want to see the payroll records on Becky and Arlene. So whatever they ask you for, get all that together. Then it's, when we were looking at those financial statements and I said, make sure that the balance sheet balances, you need to make sure your balance sheet balances before you give it to the auditors. And the other thing is financial statements tie year to year. So I mentioned on the balance sheet, the statement of financial position, that category about net assets, it's the sum total of all your net assets from prior years. So it needs to tie to whatever your change in net assets was for this year. If you take that number and add it to what it was last year, it needs to tie. So just make sure that everything that's on your financial statement ties. And then the other thing is, for key procedures in the finance area, make sure you've got some written policies, just so that they're going to make sure you've documented it and that you're following what your policy is. Just a word though about that, they will audit to whatever your policy is. So I worked for an organization, and the payroll policy said that if you wanted direct deposit, you had to give the payroll office one of your blank checks that just had void written on it. And they audited that, and a lot of people were just telling them what their account number was. They weren't giving them a blank check, and the auditors dinged us on that because we weren't following our policy. So we changed our policy. So just realize that they're going to actually help you stay current on your policies.
Another question we have: what is a single audit, and when is that one required?
Yes.
A single audit is it's if you have a federal grant if you have more than $750,000 worth in federal grants, then you have to file a federal audit, a single audit. It used to be called the A133. There used to be a whole bunch of other ones besides A133, and they combined them all together and called it a single audit because they got tired of using different forms on different clients. But they're not really auditing your financials per se. They're auditing procedures and computer systems, and the government has standards about what you have to be doing from a procedural and a computer system standpoint. So they're auditing to those government standards. They're not auditing your financials. it's a totally different audit.
Okay. I think, probably something that is going to come up for a lot of individuals who are on this Zoom today is around COVID funding and, either the loans or the grants and, PPP, all of that. Do you want to speak to any of that today?
Sure. I'll just say a few things. So the two main programs that you may have taken advantage of, the first one really that came out was the Paycheck Protection Program. And I know some organizations that made the decision to keep their staff on board because they could get that money. It is through the Small Business Administration, and it comes as a loan. And Small Business Administration contracted with banks to administer it. So when you decided to apply for it, you would select a bank. Maybe the bank you already deal with was one of the ones that could do those PPP loans. And they were the ones that reviewed your paperwork and made sure it was correct, and the money that you got back was funneled through them. From an accounting standpoint, because it was officially granted to you as a loan, you would show it on your statement of financial positions as a liability. And then when you met the terms of that loan, usually it was you either had to keep so many people on staff, or you had to be paying for rent or utilities, occupancy. Once you could document that you spent the money the way it was supposed to be, the loan was forgiven. And in essence, you would record that the loan was paid off. And the other side of the entry would be that you had some grant revenue probably. So that's how you would account for that. Then there's another one called the Employee Retention Credit, and that was actually through the IRS. And you got, I think, about half of what the people's salaries were. And it was also a lot of organizations took advantage of both plans. You had to be careful that you didn't double count. If the PPP was paying for staffing, then you couldn't use an employee credit to pay for that same staffing. So you needed to make sure you weren't doing that. And because they're administered by different programs, they had a different set of rules from the IRS than the bank would have for the PPP loans. The organizations that I've known who have applied for these two programs multiple times said that the checking of what you were doing and saying you were doing has gotten a lot more stringent. I mean, there was a lot of fraud that was publicized in that first round of Paycheck Protection Program. And they've really clamped down on that and tried to make sure that it's going to the right kinds of an organization. And to me, not-for-profits are the perfect people that should be the perfect kind of organization that should have been getting that money. In terms of how you record that employee retention credit, because it's an offset to salaries, the logical thing says you would book it as a negative salary in essence, because you were getting money from somewhere else to pay for that salary. So it was really an offset to salaries, but that's going to make your financials look wacky because you're going to have expenses lower this year than you did in private years. So people are looking at other ways to record that so that it's more consistent with the way you might have recorded things in the past. So I think that's still being worked out between entities and their audit firms about what the best way to actually book that on your financials is.
So Jeannie, we have a question from Baron. He said the employee retention program is through who?
It's through the IRS.
The IRS. Okay. And we have
I think Becky sent you just some slides, and the links to the two. There's a slide in that little packet, and it has the URLs that you can go and check out for more details on those, the IRS site and the Small Business Administration site.
We have a question from Asia. She says, with the PPP, the verbiage talked about not being able to operate as you did pre-COVID. Does that help you if you had to lay off people and still get it forgiven?
No, well, on the PPP, you only got paid for the people you kept.
Right.
So if you laid people off, you didn't get money for that. But the other thing it can pay for was it could also pay for some of your occupancy costs. So that's really independent of the people. So so it really depends on the way you put together your proposal.
Okay, because it talked about how if you weren't able to function the way you normally function, you know, pre-COVID, during COVID, it was different and affected you. You were still eligible for forgiveness.
But I think you had to demonstrate that you spent the money. So if you laid those people off, then right.
Oh, yes, you absolutely did. Yes. But I think that you could still do a combination of laying people off and being able to.
Sure. Yeah. Exactly.
So
you weren't obligated to keep all your people. No.
Right. Thank you.
So we are coming to the end of the Ask the Expert. So I want to just open it up to anyone if you have some additional questions for Jeannie in the last couple of minutes. If you haven't posted them, if you'd like to unmute yourself and ask a question, now would be the time to do that. Okay, we have a couple questions coming in the chat. So Celine says, is the 990 the same as the tax return or filed with it?
No, it's totally different. And actually, I did have a couple of slides in my presentation about the 990 because it was super important. If you want to let me share my screen again, I will be happy to do that.
Go ahead, you can do that.
Okay, let's see. I don't see the little, oh, here we go, share screen. Just let me scroll down to the right pages. I have actually quite a few different ones on this. So just about the, here we go. So Form 990. So you have 4.5 months to file it after your fiscal year end. It's really easy to get an extension for 6 months. I always do it. The main thing is it asks you if your board got a copy of this before you filed it. So please make sure they do. The Form 990 is totally independent of your audit. You may not have an audit, but you have to file a Form 990 every year. The appropriate Form 990 every year. If you don't file your Form 990 for 3 years in a row, then you lose your tax exempt status. So it's really important that you do this. These become publicly available. Not only are they expecting you to make it publicly available, like on your website, but there are at least 2 entities that get all the Form 990s and use them. GuideStar has had them forever, and you can go on GuideStar and find anybody's Form 990s. GuideStar is a little tricky. You can get them for free, but they don't make it easy for you to find the free ones. They want you to pay for a service, but you can see everybody's for free. There's another entity named Charity Navigator that's been going for the last several years, and they are actually taking the Form 990s and digesting the information and making it available for donors. And that's really important because this is what it looks like. So here's the Charity Navigator for Utah Habitat for Humanity. If you want to dive into this more at your leisure, you have their Form 990, but they look at the financials in that Form 990 and they give you a score down there towards the bottom of the screen. They give you a score out of 100 points, and they did really well here. Their overall score was 98 and their financials were 97. They also rate you on your accountability and transparency, which is, are you making your financials and your board available on your website for everybody to see? So they did really well here. The next thing that they do is they compute some financial metrics. And the most important one is that top one. There's a sheet in the Form 990. It's pretty much where all the statement of activities, where all the income statement expenses go. And you divide all your expenses up onto whether it specifically relates to a program or whether it's administrative, like, for the CEO salary, or whether it's for fundraising. And then they compute ratios. And here, the program expenses for this organization was 92% of their total expenses, which is fantastic. donors look at this, and if you score below 70% on that top line, they're not going to give you any money. That means for every dollar they give you, you're spending 30 cents of it on administration and fundraising, and that's not what they want to fund. So 70% is sort of the rock bottom. Most organizations give for at least 80%. So that's the ratio here that they're really looking at. The other thing is, I pointed out on your balance sheet, they want to know that you're not heavily in debt. And the very last line on this page is the liabilities to assets. So they look at your debt and they divide that by your total assets, and they want to make sure you're just not too heavily leveraged. So then here are some of the key questions that were listed on the Form 990. Independent board members. You may or may not know that if your board members are related to each other, they are not independent. And they want to make sure that your board members are independent. It doesn't mean you can't have related board members. It just means that they can't comprise the majority of your board. And you have to disclose it on your Form 990. Here they're asking some of the things we mentioned about, are you making loans to or from your board or your employees? Do you have key policies like conflict of interest and whistleblower? And how'd you come up with your CEO's salary? Are you using any external data, and is your board approving it? So all of this stuff is on your Form 990, and that's what Charity Navigator has done a great job in digesting that Form 990 and picking out all the key stuff and putting it on their website. So go to Charity Navigator and check yourself out. See what they say about you, because it's pretty interesting. It will give you and your staff religion about what you ought to be paying attention to.
Yeah, as a grant writer, I will also say there are some funders that require you to be on Charity Navigator and GuideStar in order to fund you. It's one of the first questions they ask.
Yeah.
We have a local funder here that does that. So if you're not on there, you're not going to even be considered for funding.
Well,
so
you don't really have a choice. They get both those two organizations get your Form 990s from the IRS.
Right.
So, and there is about a 2-year lag. It takes them about 2 years to get your Form 990. So for the first couple of years, you may not have your stuff out there.
Yeah, and if I have also found that if you're on Charity Navigator and maybe there's something that you don't quite agree with or you didn't score as high, there are some opportunities for you to fix some of that, especially like in regard to transparency and what's available on your website and things like that. So you can fix some of those things. We have one last question, Jeannie, before we wrap up, and this is from Romeo, and it is, if the PPP loan only covered about 2 pay periods, can you claim the employee retention program for prior and after those pay periods?
Boy, I am not an expert on that, and you would need to get some professional advice.
Okay.
I'm sure the IRS who handles that employee retention program would be able to clarify that for you.
Okay, thank you very much. So we are at the end, and if there are no further questions, we just want to thank you, Jeannie, for coming on today and sharing your financial expertise with us. We really appreciate it. These are all questions that people, have throughout their time in dealing with their financials for their organization, and it's great to just have someone with your experience that we can reach out to and to have it in such an intimate forum. So thank you so much. I appreciate it. And I will turn it back over to Becky for any last minute SVP information. Please be on the lookout for this series of Ask the Expert. And if there are any suggestions that you have for us to cover on a particular topic, please let us know. We want to bring you the information that is most pertinent and important to you. So with that, Becky, please take over.
Thank you to, again, Arlene, for all your time and getting ready for this. And for those of you who are out there, Suzanne and Jimmy.
Hi, Suzanne and Jimmy.
Hi, Jeannie. Great job.
Very good.
And so now you understand why Jeannie is so valuable to social venture partners and just her knowledge. She also did some magic at the Alamo while I was there. So she has just been wonderful to me for a very long time. you know, you'll get, if you registered for this, you will get a survey from us. And on that, it will have some ideas and anything that you can add to for the next topic. And we should put out within the next week who the June speaker is going to be, expert. And so just kind of watch for that. Share this with your nonprofit friends, with your staff, if this is an area of expertise you want to share with them. Just want to be able to make this as a resource for everybody here. Thank you too for those partners who've joined us, and a couple of funders here. We really appreciate all that you do to support our nonprofits here across San Antonio. And have a great rest of the day.
Bye.
Bye-bye.
Bye-bye. Thank you.